Hello, I'm David Bradbury, the head of the Tax Policy and Statistics Division here at the OECD's Centre for Tax Policy and Administration. It gives me great pleasure to welcome you all to this special webcast today, where the OECD Secretariat will be presenting some preliminary results and insights from the work that we've been carrying out on the economic analysis and impact assessment for the various proposals that have been brought forward and are being considered by the Inclusive Framework as part of its efforts to address the tax challenges arising from digitalisation. You would be aware, for those of you that have been following the work of the OECD and the Inclusive Framework, that in May last year the program of work was issued in relation to the work that is being carried out. And as part of that program of work, there were the two pillars. The first pillar, involving the allocation of taxing rights, and the second pillar being about the Globe proposal, a minimum tax proposal. They were outlined in some detail. In addition to those two pillars, there was also reference to the work of the economic analysis and impact assessment. And what we will present to you today has been carried out under the instructions that were issued as part of that program of work. And the program of work specified that the work was to be carried out by the Secretariat, and that has been the case, but I do want to acknowledge the very good cooperation that we've had from country delegates from the Inclusive Framework with its 137 member jurisdictions. But here at the OECD, we've brought together some of the best and most capable economists across the House in order to take on this very significant challenge of trying to undertake an impact assessment of these proposals. And in particular, that involves a collaboration between the Centre for Tax Policy and Administration and the Economics Department. And you'll be hearing from colleagues from both of those directorates today. But I should say that our work has also been supported and informed by contributions from other parts of the OECD, which really does reflect the very significant regard that we have for the work at hand. A few weeks ago, the Inclusive Framework met, and the results that will be shared with you today are a summary of some of the results that were presented to member jurisdictions at that meeting. You may also be aware that a statement was issued at that time that also indicated that whilst the work that has been carried out on the impact assessment so far has been welcomed, we have also been called upon to carry out some further analysis, in particular on the growth and investment impacts of the proposals, and to do that by the end of March. But today we will present to you a range of preliminary insights from the work that we've been carrying out. I'd like to take the opportunity to introduce some of my colleagues who you'll be hearing from throughout the afternoon. Åsa Johansson, who is the head of the Structural Surveillance Division at the Economics Department. Åsa is on my left, and on her left is Stefan Sorb, who is also from the Economics Department. On my right is Tibor Hanepi, also in the Centre for Tax Policy and Administration. Today, we will be sharing some high-level preliminary findings. We will then outline some of the approach and the caveats that underpin the approach that we've undertaken in terms of the methodology. We will also share with you some high-level results in relation to the revenue impacts, both of Pillar 1, Pillar 2, and the combined effects of the two pillars. We will also share with you some of the early work that we've carried out on the investment effects before turning to the next steps and providing you all with the opportunity to ask any questions. Now, I think one of the important words here is preliminary, that the work that we are sharing with you is still preliminary. Now, in terms of the purpose of the impact assessment, it is very much focused on ensuring that we are able to bring some evidence and some analysis before delegates of the Inclusive Framework, so that as they take some of the key decisions around the negotiations, that is informed by analysis that has been undertaken. So that really has been one of the primary purposes of the work that we've been doing. In terms of the purpose of today's webcast, it's really an opportunity for us to share with you, the broader public, some of the insights and results that we've been able to discern at this point. Now, I know I've seen there is a lot of interest in the presentation today, and there have been a few articles that I've read over the last couple of days. Some have said that this is far too early in the process to be presenting any results. Others have said that we should have done this 6 months ago. Assuming that we're somewhere between in the middle of the range, perhaps we're getting it right. But we really are taking this opportunity at this point in time to ensure that we are able to bring some analysis into the public discussion and hopefully not only inform delegates as they take decisions, but inform the broader public discussion. Now, in presenting any analysis at this stage, when there are still many decisions to be taken by the Inclusive Framework, clearly many assumptions will need to be taken. And those assumptions, they range from assumptions around the design, around some of the key parameters, and these things haven't been finalised. But in addition to that, any analysis will have to take into account some simplifying methodological assumptions. We operate in an environment where there is never perfect data. These are limitations that we face. Now, what we seek to do is to be as transparent about those issues as possible, and we will outline some of those issues in the presentation today. I should say that the slides that we put on the website after this event will also have an annex that will detail in some more granularity some of the issues around the data and the methodological aspects of our work. But most importantly, I want to make this point, that notwithstanding the assumptions that we have inevitably had to take in order to present any results to you today, we want to make it very clear that we are not in any way seeking to prejudge decisions of the Inclusive Framework that have not yet been taken. But of course, in order to model anything, you have to input certain parameters, and we've made certain judgments and assumptions that we'll share with you. Today, we will be presenting high-level results. By that, I mean there will be global results in terms of revenue impacts. There will also be results at the level of jurisdiction groups, but there will be no results presented today at the country level. So jurisdiction group results means that we will present results in various classifications such as high income, middle income, low income and investment hubs. And of course, as the process proceeds and as the negotiations and further decisions are taken, we will be on an ongoing basis updating this analysis to take into account the latest developments. And we have, to the extent possible, sought to do so in the modelling thus far, but as this is a fast-moving process, that will continue to change as we move forward. So now if we can turn to some of the high-level insights and preliminary findings, what we find is that the combined effect of Pillars 1 and 2 would lead to a significant increase in global tax revenues. And by that, we mean that we've estimated a global net revenue gain of up to 4% of global CIT revenues. 4% of global CIT revenues is around $100 billion US, and that's annually. Now, obviously, this depends on reform design, but you will see in the coming slides, in the coming moments, the assumptions and the parameter choices that we've made. But 4% of global CIT. We also find that the revenue gains are broadly similar across high, middle and low income economies. That's as a share of corporate tax revenues. Now, obviously, within these categories of countries, there will be variation, but across those country groupings, we observe that the gains are broadly similar. We also find that the reforms can be expected to lead to a significant reduction in profit shifting, and we will go through that in some detail throughout the presentation. And of course, we note that a failure to reach a consensus-based solution will lead to further unilateral measures and greater uncertainty. And we see that in the world around us today. We know that the counterfactual of not reaching agreement is indeed a world with more uncertainty and future unilateral measures. At this point, I'll now hand over to Åsa.
Thank you, David. Thank you, David. So I will go through now the approach that we have used to assess the reform impact. And since our purpose is to inform the discussion at the Inclusive Framework, we have set up a flexible analytical framework And in this flexible analytical framework, we can test a range of different design assumptions on Pillar 1 and Pillar 2. And since the inclusive framework consists of a wide range of countries, we have a broad geographic coverage and also company coverage. We cover more than 200 jurisdictions, including all members of the inclusive framework, but we also cover a large number of companies. And given that there is no unique data source that is perfect for this type of exercise, we have been combining data sources from a range of different sources. And we try to rely as much as possible on firm-level data in order to be able to build a comprehensive database. So currently we have 27,000 multinational groups in our sample. And we combine this extensive firm-level data with aggregate data. And one of the key aggregate data sources that we are relying on is country-by-country reporting data. And this data has been shared with us on a confidential basis by more than 20 jurisdictions. And it contains the data on taxes and profits and activities of multinationals. As David already have mentioned, we have throughout the process have an extensive interactions with different stakeholders, notably delegates from the inclusive framework, academics, and also country experts. And these interactions have helped us to improve upon the data quality and also the methodology that we use to advance the work on assessing the impact of the different reforms. So before I go to the results, I will just address the issue of main caveats. As any quantitative analysis, this work has caveats, and they are important to keep in mind before we go through the results. And most importantly, the results that we presented here today, they will depend on the ultimate design of Pillar 1 and Pillar 2, and this design is yet to be determined by the inclusive framework. So our work should be seen in this regard as preliminary, and further revisions will be taking place as the inclusive framework is advancing their work. And among one of the assumptions that we made is that the current estimate of Pillar 1 is that it's not a safe harbor regime. And in order to do our work, we have combined the best data that is available. But as you know, all data has limitations, and those limitations are reflecting gaps in the data coverage or also timeliness of the data. So one of the important data issues is that the last year, for which we have comprehensive data for the key data sources that we use, notably country-by-country reporting data, refers to the year of 2016. We have also had to make some methodological simplification in order to do the modeling of the different pillars. But we are still refining the data in interactions with the member countries and the inclusive framework members, and our aim is to try to update the database as the process goes along. And another caveat to the work that we have done is that we have tried to model some of the potential strategic interactions of firms and governments to the proposals. But as you know, assessing strategic reactions of firms and governments are difficult, as there are many possible ways that they could react to the proposals. So we have aimed to model a few of them, and they will become clearer later on in the presentation. But that's another issue that one needs to take into account. So now let me turn to some of the revenue effects of Pillar 1. So Pillar 1 is about changing the way countries carve up the tax pie, and it's an important change to the international tax system. So Pillar 1 involves a substantial reallocation of taxing rights across jurisdictions, and in the way it does that, it goes beyond fiscal presence to determine who has the right to tax certain profits of multinationals. And in doing this, it considered a multinational as a group rather than as an entity by entity. And this is a large change to the international tax rules. And what it does is that it allocates some of the tax base to the market jurisdiction based on a formula. So let me be a little bit more explicit what it actually entails. So what Pillar 1 first does, it is to determine the total profit of a multinational group, which is in this illustration the sum of the three bars that you see here. And up to a certain threshold, a profitability threshold, profits are deemed as routine profit, and this profitability threshold could be, say, 10, 20, or 30% of profit before tax to turnover. Profit above this threshold is deemed as non-routine profit. And this threshold is a threshold that is a significant parameter that needs to be determined by the inclusive framework, which is still yet to be decided. And above this threshold, a number of this routine profit would then be allocated to market jurisdictions. And this share to be allocated to market jurisdictions is also a key parameter that will be decided later by the inclusive framework. So our estimates that we have done so far will be updated with new information based on the decision taken by the inclusive framework. So here we have our preliminary results for Pillar 1. And the way to read this chart is that we have modeled different scenarios. And in this chart, we show two scenarios with two different profitability thresholds, one on 10% of profit to turnover and one on 20%. In the chart here, we also assume that the share that will be reallocated to market jurisdiction is 20% of non-routine profits. And the way the chart shows is that at the top of the chart, we see the impact of global tax revenues, followed by different income groups. And these income groups are based on the World Bank's classification of high, middle, and low income economies. At the bottom of the chart, we see the results for investment hubs. And in our work, we have defined investment hubs as countries or jurisdictions where you have large foreign direct inflows to GDP ratios. And these jurisdictions are often jurisdictions with relatively low effective tax rates. So one thing here also is to note that we present results as ranges, and these ranges, they are to reflect that there are uncertainty, and there are both in the terms of data limitations and also on reactions of multinationals. And what you can see here now, at the top of the bar of the global tax revenues, we see that they range between 0 to 1% of global CIT revenues, and the revenues tend to be higher from lower and middle income economies relative to high income economies, whereas investment hubs, they tend to lose some revenues. So the key insight from this chart and the work we've done is that most jurisdictions, they will gain tax revenues except investment hubs. But as we already mentioned before, we will continue to update our work as decisions are being made by the inclusive framework. This just illustrates one set of scenarios as possible from the work that's been ongoing. So let me just sum up the results. So in addition to reallocating taxing rights, which is the key purpose of Pillar 1, Pillar 1 would also slightly increase tax revenues. And the global tax revenue would slightly increase, and the reason for this is that some taxing rates are shifted from low tax jurisdictions to higher tax jurisdictions. And on average, as I already mentioned, low and middle income economies would gain relatively more than advanced economies, whereas investment hubs would experience some losses in tax revenues. And we have done some more detailed analysis, and this analysis suggests that more than half of the profit reallocated comes from about 100 multinational groups. So that was the key findings that we had on Pillar 1. I will hand over now to Stefan for going through Pillar 2.
Thank you, Osa. And so after Pillar 1, let me turn to Pillar 2. And for Pillar 2, what we've been modeling is called the GLOBE proposal, and it works as a minimum tax rate. So the idea is that it would give, in practice, countries the right to tax back some profit when it's taxed below the minimum rate abroad. And it would work as a top-up on the existing tax, so the tax would be a top-up to reach the level of the minimum tax. Then the rate of this minimum tax has to be determined by the inclusive framework as other reform parameters. And so what we've been doing is to model the effect of a range of possible minimum tax rates. And the results I will present in the following slides are based on a 12.5% rate, but this is an illustrative assumption. Another thing that the inclusive framework has to decide is the way this minimum rate would be applied. Is it done on the global profit of the multinational, or is it done jurisdiction by jurisdiction? And so we've been exploring both options in the modeling, and the results I will present are based on the jurisdiction by jurisdiction approach, which in general is stricter than the global approach. So that's how Pillar 2 works. And for Pillar 2, we've been trying to take into account some behavioral reactions of multinationals and governments in the analysis. And this is because we think that these reactions are likely to be more pronounced for Pillar 2 than for Pillar 1, and so we thought it's important to take them into account. So let me go through the different scenarios that we've been considering. So we start from the scenario 1 at the top, which is the static scenario, which is basically the scenario without taking into account any behavioral reaction. Then we move to a second scenario, the scenario 2, which takes into account the interaction of Pillar 2 with Pillar 1. So it's the idea that Pillar 2 is not implemented in isolation, but it would be implemented jointly with Pillar 1, which means that its effect could be slightly different because of it. But as we will see, it doesn't make a huge difference in the estimates. Then we move to scenario 3, where we take into account the fact that multinationals, in reaction to Pillar 2, may change their profit-shifting strategies. And what we expect is that Pillar 2 would generally reduce tax rate differentials between jurisdictions. And so we think that it would reduce the incentive for multinationals to shift profit to low-tax jurisdictions. So it would not eliminate profit shifting, but it could reduce profit shifting. And so that's what we've been modeling in this scenario. And then the fourth scenario, we've been taking into account the potential reaction of governments to the introduction of Pillar 2. And that's a more uncertain area, but what we've been modeling is the idea that some jurisdictions where the tax rate is currently below the minimum could increase their tax rate to collect some of the revenues from the minimum tax, with the idea that it wouldn't change the tax liability of the multinationals, but it would allow them to collect part of the gains from the minimum tax. So that's the scenario that we're looking at. And so let me turn to the results for these four scenarios. So what you see in this slide is the global tax revenue gains estimated from Pillar 1 and Pillar 2. And again, I should stress that this is just an illustrative scenario on the Pillar 1 and Pillar 2 design and parameters. And so if we start from the left-hand side bars, so the first scenario, which is the static, you have a green bar, which corresponds to the gains from Pillar 2, and a blue bar, which corresponds to the gain from Pillar 1. And as you can see, the green bar is larger than the blue bar, and I think that's what we would expect given the characteristics of Pillar 1 and Pillar 2. So that's in line with what we expected. Then when we move from scenario 1 to scenario 2, so we take into account the interaction between both pillars, but as I was saying, it doesn't make a big difference in terms of the results. So it reduces the size of the green bar slightly, but not by much. So it shows that even the modeling the two pillars at the same time doesn't make a big difference compared to modeling them in isolation. Then what makes a big difference is when we move to scenario 3, and then we take into account the fact that multinationals may reduce their profit shifting intensity, and that gives you an additional tax revenue gain, which is this red bar that you can see on the screen, and that's the extra revenue gain from some profit no longer being shifted to low tax jurisdictions and to being taxed in the places where they are generated. And finally, what's happening when we move to the scenario 4, the overall size of the bar doesn't change, so the total global revenue gain is the same, but what changes is the distribution of these gains across countries. And what's happening is that some jurisdictions increase their tax rate, and they are collecting what you see in yellow. So the yellow part of the bar is what these jurisdictions collect by increasing their tax rate, but the overall global tax gain remains the same. And so as you can see on scenarios 3 and 4, this overall tax revenue gain, when you add up the gains from Pillar 1 and Pillar 2, is close to 4% of global corporate tax revenues. And that, again, this is in this specific, with these specific assumptions and parameters. And 4% of global CIT revenues, as David was saying, represents about $100 billion per year. So to sum up the key results on Pillar 2, the main finding is that Pillar 2 could generate a significant amount of extra tax revenues. Obviously, it would depend on the rate of the minimum tax and on the design of Pillar 2. And the other important finding is that we think Pillar 2 would reduce the intensity of profit shifting by multinationals. Again, because the tax rate differentials would be reduced. So for some multinationals, it may not be worth engaging in some profit shifting structures, given that the gains in terms of tax rate differentials would be reduced. And so this would benefit jurisdictions that have tax rates that are above the minimum rate, including the low-income jurisdictions and the developing economies that tend to suffer a lot from profit shifting in the current situation. So now let me turn to the combined effect of Pillar 1 and Pillar 2 on global tax revenues. And so that's this we present for the income groups, the same as Osa was presenting earlier, so for high income, middle income, and low income jurisdictions. And what you can see here, so it's the bars are the same color, so you have Pillar 1 in blue, Pillar 2 in green, and then the extra gain from reduced profit shifting in red. And so what you can see is that across these three groups, you have relatively similar levels of gains. So you have broadly comparable gains. But there are differences in the composition of these gains. So for instance, if you look at the low-income jurisdictions, they have a bigger blue bar, which means that they gain more from Pillar 1 than the other groups. But overall, when you add up the different bars, you see that the gains are broadly comparable across income groups. So let me stop here on the revenue and hand over to Tibor for the investment analysis.
Thank you. Thank you, Stefan. I will continue now by saying a few words on our investment analysis, where we look at the investment effects of Pillar 1 and Pillar 2. So how are we doing this? Basically, we assess the investment impacts based on a stylized standard framework. And we have three different components that feed into the investment analysis. The first component is already the most progressed. So the results that I will show you in the next slides are based on the first component of these three. The other two components are work in progress, so that they will produce additional results a little bit later. So what do we do in this first component? We base this analysis on the corporate forward-looking effective tax rate framework. So that's building on a methodology from the economic literature that builds also on publications, for instance, by Michael Devereux and Rachel Griffith. And what we do is we basically develop this methodology to incorporate profit shifting behaviors by M&Es. We also capture the effects of Pillar 1 and Pillar 2. And the other element that we're also adding to the analysis that we calibrate this model empirically based on the data that's also underlying the revenue estimates that Stefan and Asa have just presented. So that's completely consistent there. And the main idea with this approach is that we look at a stylized investment project and then compare the effects before and after the introduction of Pillars 1 and 2 for a range of stylized M&Es. So that's what you will see on the next slide. Component 2 would look further into the impact of ETRs on investments and how that may vary across firms. So here we again looking at firm level data to understand better how this variation looks like. And the third element that is important for the investment analysis is the assessment of the counterfactual scenarios where there would be no agreement and more unilateral measures. And that's also something that we want to look at in order to have a correct comparison point, so to say. So now if we look at the results that we've already developed for the first component of the investment analysis, we can see here that the overall assessment is that there could be a small increase in the forward-looking effective tax rates, with the biggest effects happening for M&Es headquartered in investment hubs. So here again we have an illustrative scenario on Pillar 1 and Pillar 2, as was the case in the revenue estimate analysis, and we're using the same design assumptions without prejudice as before in Stefan and Asa's analysis. So that would be a 10% threshold on profit to turnover to determine non-routine profit with a 20% reallocation for Pillar 1, and for Pillar 2 a 12.5% rate with jurisdiction blending, just to remind you. So if we now look at the graph, we see on the right-hand side the combined effect on M&Es headquartered in all jurisdictions, GDP weighted. So here you can see that's not the absolute level of the ETR, but just the change due to the introduction of Pillar 1 and Pillar 2. And if you look at the y-axis on the left-hand side, you can see that the overall effect is rather small, around 0.5 percentage points. And the second element that we find from this analysis is that the larger part of this effect is driven by Pillar 2 as compared to Pillar 1, which produces a much lower effect on the effective tax rate. So now if we look at the left-hand side, we can see the three additional bars that basically disaggregates these results for MNEs active in different types of countries. So this would be high-income countries, low-middle-income countries, and investment hubs. And if we look at that, we can see that MNEs headquartered in investment hubs will be mostly affected by the introduction of both pillars. So that's the other important takeaway from this graph. And with this, I come to the next slide, basically summarizing the findings so far. So we find a small effect on investment costs. That's what we just saw from the effective tax rates. But on the other hand, we also expect a potential for improved tax certainty, which would counteract this small effect on investment costs. So to be a bit more precise, the direct effect on investment costs is expected to be small in most countries. And this is the case because many firms will be unaffected by the proposals, which target firms with high levels of profitability and low effective tax rates. A second, also very important point and a very important outcome of this analysis is that the reforms would reduce the influence of corporate taxes on investment locations. Why do we think that that would be the case? As we've just seen in the previous graph, MNEs headquartered in investment hubs would be most affected in terms of their effective tax rate. So this would increase the effective tax rate faced by MNEs active in jurisdictions with lower tax rates. And that would then act to reduce the dispersion of effective tax rates, which would imply that investment could be driven more by other factors rather than corporate tax-related factors. These other factors could be, for instance, infrastructure, education levels, labor costs, and others. And this, in turn, would lead to a more efficient allocation of capital across jurisdictions, therefore possible increases in productivity, leading to a further support for global growth. And as I already mentioned before, the relevant comparison would be to compare that to a counterfactual where there might not be a consensus-based solution, and that would lead to more unilateral measures, so uncertainty and trade disputes. So this is the other element that we're still looking at in this context. And with this, I'll pass on to David.
Well, thanks very much, Osa, Stefan and Tibor. And just reminding you all that if you do have any questions, please send them through. A couple of questions have come through already. And just to emphasise some of the points that have been made, the modelling that has been undertaken has been done through a very flexible framework that does allow us to take into account decisions that will be taken in the future by Inclusive Framework members. And even though there has been a considerable amount of work done, in particular on the revenue estimates, as the statement from the Inclusive Framework in January indicated, the work that Tibor has just presented on investment effects, we are being asked to intensify our efforts on that work between now and the end of March, and we will certainly do that. In terms of this work in the context of the broader project, as many of you will be well aware, it is a very ambitious timeline, and having started back this year with the Inclusive Framework meeting a few weeks ago, there are a number of important milestones. The finance ministers meeting, the G20 finance ministers meeting in a couple of weeks' time. And then, of course, a very important meeting, the Inclusive Framework meeting in July in Berlin, where it is the objective that agreement be reached on key policy features of a solution. So that is a very ambitious timeline. Of course, after that, we have the G20 finance ministers and the G20 leaders in July and then in November. As I indicated earlier, the principal objective of the work that we are carrying out here on the impact assessment is designed to support the Inclusive Framework members as they grapple with the very complex questions that are in front of them as part of the negotiations here at the OECD to try and find this two-pillar solution to the tax challenges arising from the digitalisation of the economy. Now, I understand that we have received some questions. If I can begin with a question that we've received on country-specific results. And we have been asked, today you presented global results and results for country groups. Are you going to be releasing any country-specific results? And if so, when? That's a good question, and as I said, the work we're doing is supporting members, and we are very privileged in a sense that we have the opportunity to work directly with tax policy officials in the 137 jurisdictions of the Inclusive Framework, and that is strengthening the analysis. We are benefiting from the data that we are receiving, some of it confidential, as Ossa mentioned. But in terms of country-specific work and country-specific results, to this point we have actually developed some tools for countries that allow them to play with different parameter choices and different design choices to estimate the revenue impacts on their jurisdiction of the reforms. That is something that we have been doing on a bilateral basis. It's something that we continue to work closely with countries who, as I said earlier, are really feeding us with more and more data and more of their insights to ensure that our analysis has been strengthened. The presentation today did not involve any country-specific results, and there's a couple of reasons for that. The first one is that given that the design choices are still to be taken, it has been the view of countries that it is too early to be releasing those results, and in fact, because of the ongoing bilateral discussions with countries, we are not yet in a position to do that. But it is our intention to release results with a greater degree of granularity to give people a greater picture of what the impacts on different countries might be. So in the future, we hope to be able to do that, but that's one that you'll have to stay tuned for. In terms of other questions coming through, we have two questions on the data, and the questions are both basically asking if we could give a little bit more information about the data that is being used. I think for this one I might ask Stefan to have a look. In fact, we might even track through to some of the slides in the annex that I mentioned earlier that we didn't present but will be posted online for you after the presentation. And Stefan might like to take you through some of those. Just to highlight that there will always be data limitations, but I think we are very fortunate to have access to the country-by-country reporting data. And whilst it's not perfect, it has its limitations as any data source does. We have benefited from the willingness of countries to share that with us on an anonymised and aggregated basis. But as Stefan will demonstrate, we are drawing upon a range of data sources in order to pull together what I think is a reasonably impressive piece of work.
Thank you, David. And so yes, I've been turning to one of the annex slides, and as you will see, there is more detail on the data and methodology in the annexes of the presentation. So it will be on the website after the presentation. If I will not go through all of these annex slides in details, but just try to highlight a few key things about the data. And so as David was saying, we've been trying to combine data from different sources, and this is because we try to inform a very wide range of jurisdictions, so the more than 130 jurisdictions in the inclusive framework, and there's no unique data source that can answer all the relevant questions about Pillar 1 and Pillar 2 for all these jurisdictions. So what we've built, as Ossa was explaining, is to try to do a consistent analytical framework, combining the data from different sources in a consistent way to then be able to assess the impact of Pillar 1 and Pillar 2 under different design and parameter choices. And with a lot of interaction with country delegates, which have provided us with extra data and which have also checked the consistency of the data that we are using. So to be a bit more specific, we are trying to rely as much as possible on firm level data, which is more granular, more precise than the aggregate data. And so we have a very broad sample of firm level data. As Ossa was saying, it's 27,000 multinational groups. It is combining data from consolidated financial accounts from the Orbis database and from WorldScope in combination with other sources. We've done extensive data checks and extensive cleaning of this data, building on many different projects that the OECD has been working on in the past using this data set. So we build on a lot of expertise to use this data. And so that's the firm level data. Then we rely also heavily on the country-by-country reporting data, as David and Osa were saying, and it's a very useful source that has its limitations, but is also a big step forward in terms of having data on especially on the location of multinationals' profits. And this country-by-country reporting data has been shared with us on a confidential basis with more than 20 jurisdictions for the moment. Then we know that we also have to fill some gaps where the other data sources are not available, and so in some places we are relying on extrapolations based on other data sources, so more aggregate data, including FDI data. And so let me explain a little bit. One of the way we've combined these data sources is presented in the slide that you can see. It's what we call the profit matrix, and it is a way to map the location of the profit of multinationals across jurisdictions and for different jurisdictions of headquarters. So each column would correspond to one jurisdiction of headquarters, and one line would correspond to the jurisdiction of the affiliate or the jurisdiction where the profit is located. And so it's a very big table, more than 200 by columns by 200 lines. So this is a very simplified, stylized version with just 4 countries that you see here. And what we've been doing is to fill this, so which is locating the profit of multinationals and combining the different data sources in this matrix. So one of the primary data sources that we use is this aggregate country-by-country reporting data, and this gives us columns in this matrix. So for instance, the US country-by-country reporting data would give us information on the profit of US multinationals and where it is booked across all these jurisdictions. Then we also use firm level data from Orbis, so that's the source number 2, and that gives us, we use it only in jurisdictions where the coverage of Orbis is very good, so it's primarily European countries, but a few others as well. And this gives us more lines in the matrix, so it gives us for one jurisdiction of affiliate, where is the ultimate parent entity, and so to which column the profit belongs. Then we also use the OECD data on activities of multinational enterprises, which is also a useful OECD data set that also tracks the activity of multinationals. And then to fill the gaps, as I was saying, we use extrapolations based on macro sources, including FDI. And so what's nice about this approach is that we combine the data sources, so we don't have like one estimate per data source, but we put them together. And in certain cells, as you can see on this slide, we have several data sources covering the same cell, which allows us to benchmark the data sources against each other. And so that's a very useful consistency check to make sure that we check that the data are sufficiently consistent to be combined in this way. And what we've been seeing is that it's very reassuring in the sense that for a given cell, when we have several sources covering it, the signals that we get are well aligned and well correlated. So that's a very reassuring consistency check. And then the other very reassuring check is that we've interacted on all these data with country delegates from jurisdictions in the Inclusive Framework, and it's been very fruitful exchanges, so it helped us refine the data, spot things that needed to be refined, and a number of delegates have shared with us confidential data on a bilateral basis to improve and refine this data set. So all this to say that we've done a very intense data work trying to combine the best available data sources for us in a consistent way, and this underpins the analysis and the estimates. Let me hand back to David for more questions.
Thanks very much, Stefan. And a few more questions have started to roll in. I might just run through a few of them and then we'll answer them. There is a general question around how Pillar 2 was designed for these calculations. I might hand that to Stefan, although beyond some of the parameter choices that I think have already been outlined, jurisdiction blending, 12.5% is one of the main assumptions. There might be some other comments that Stefan would like to add. Also on Pillar 2, there is a question about did you estimate the relative or respective impacts of the under-tax payments rule and the income inclusion rule? We also have a question which I think is principally directed to Pillar 2. Have you considered yes, have you considered the beggar thy neighbour behaviours in your modelling leading to a reduction in tax rates once the minimum tax is known? And also, have you looked into the impact by industry segment? Perhaps if I address the industry segment question and then hand over to Stefan on the Pillar 2 elements. Firstly, on industry segment, we have undertaken some work. Clearly, we have not presented anything specific. OSA mentioned at one point there that under the assumptions that we use when we look at where the residual profit that is allocated to market jurisdictions come from, that we see a concentration amongst a group of firms in the order of 50% of that coming from around 100 M&E groups. In terms of going into more granularity, these are questions that will be very sensitive to some of the final decisions on scope. And on that basis, we have decided not to present anything at this point. But certainly some of those key scoping decisions, of which there is some clarity coming out of the outline document that was released after the Inclusive Framework meeting. But indeed, there are some areas that continue to be the subject of discussion, and they will have impacts in terms of industry sectors and segments that will be affected. So more to come on that, but at this stage, as you've seen, we've not presented anything specifically on those issues. I'll hand over to Stefan.
Thank you, David. So a few more details on the Pillar 2 design that we've been modeling. And again, this does not prejudge final decisions to be taken. It's more that we had to take assumptions to illustrate potential consequences. So as I said earlier, we've been modeling, we've been presenting in these slides the results for a 12.5% minimum tax rate, but we've explored other rates in the analysis as well. And we've been presenting the results here for the jurisdiction blending scenario, that is applying the minimum rate jurisdiction by jurisdiction, but we've also explored the consequences of applying it at the global level on the global income of the multinational group. And another important element is that, and answering the second question, is that we've been modeling an income inclusion rule and under tax payment rule. And so we've looked at the effect of both of these rules. Basically, the income inclusion rule, the assumption is that the tax revenues would accrue to the jurisdictions of the ultimate parent entity of the multinational group, while for the under tax payment rules, it would be applied transaction by transaction. So when, like on the transaction where the financial flow or the profit is moving to a jurisdiction where the rate is below the minimum. And so for this, we've been, we don't have the data on each transaction, but we've been using as a proxy the location of the economic activity of the multinational to have a proxy of where the tax revenues would accrue. So that we've been considering both in the analysis, and for the purpose of the modeling, we've been assuming that the income inclusion rule was applying prior to the under tax payment rule. So that's basically how we've been doing the modeling on Pillar 2. And then coming to the next question on the beggar thy neighbor policies. So in terms of reactions of governments, there's quite an important amount of uncertainty as to the reaction of jurisdictions that have a tax rate below the minimum. And here we've modeled the idea that some of them could increase their rate. Then we've not modeled in the scenarios that you've seen reactions from jurisdictions with relatively high tax rates or tax rates above the minimum. And it's an open question if some of them would reduce their rates, increase their rates. We looked at the economic literature on the tax competition and the relationship between minimum taxes and tax competition. And actually, depending which papers you look at, some people would say that the rates could be reduced, and some people say that the rates could be increased. So that's why we've kept this out of the modeling for the moment, but that's an uncertainty to be aware of as well. Thank you.
Well, thanks very much, Stefan. We have received at this stage, we only have one further question. So if you haven't asked your question yet, this might be a good opportunity for you to send something through. We have a question In relation to other studies that have been released, and to what extent does the OECD's findings align with some of the other studies that have been released? Of course, there have been some studies. I note that there have been a few that have been released in the last few weeks. Indeed, in the life of this project, we have seen a number of them already released. I do know that apart from the work that we are doing, colleagues at the IMF, the EU and ATAF have been undertaking some analysis, and we've been working very closely with officials in a very collaborative way from all of those organisations. In addition to that, because of the way we commenced this process by engaging very directly with the academic community, a number of the academics that are out there modelling work at the moment, we have been sharing insights and ideas certainly throughout the process in terms of research design, methodology and available data sources. I would say that in general, and certainly in terms of the engagement that we've been having with the international organisations, IMF, EU, ATAF, we see reasonable alignment in terms of the findings that we have. They typically use different research methodologies, different data sources, and in fact, in some cases, are modelling quite different propositions. So you have to take those issues into account. But taking those matters into account, the general overall direction of findings appears to be quite consistent with the early preliminary findings that we have. I think one of the advantages that we have is, as we've already mentioned, access to the country-by-country reporting data. That is something that at an aggregated and anonymised level will be made publicly available in time. But we have that. We have confidential information in addition to that countries have been able to share with us. That has strengthened our analysis. But as Stefan mentioned, we've been using a wide range of these data sources. I think the other advantage that we have is the expertise and the very constructive comment and feedback that we've been receiving from delegates from the Inclusive Framework member countries. This is something we are indebted to them. They're dedicating a lot of their time to support our work, and that bilateral engagement with countries, I think, really has helped strengthen the analysis and make sure that all of what you're seeing presented today has been through a process of testing in front of those delegates over time. But of course, we welcome any suggestions. We don't pretend to have a monopoly on knowing exactly how to crack this very difficult nut. So please share your ideas with us. I'm just checking to see if there are any other questions coming through. I have a question that has just come through on Pillar 1. How is the deemed residual profit amount A allocated between market jurisdictions and trade intangibles? So that's a question that goes to both design but also the methodology of modelling. What we have done in our modelling has been to determine a profitability threshold, which you saw results presented there at both the 10% and 20% profit before tax to turnover threshold. We have then determined the extent of profit above that threshold, and then we have allocated 20% of that to market jurisdictions. We have not sought to disentangle that above the profitability threshold amount according to what extent it relates to marketing intangibles or trade intangibles. We have taken a percentage and allocated a percentage of that above the profitability threshold amount to market jurisdictions. So I hope that answers that particular question. I think there may have been another one that has come in. A question about why is it that in all countries gain except investment hubs? Shouldn't some countries lose? Look, I'm happy to speak under the control of colleagues on this, but the first point to make is, and I tried to make this point earlier, that these are country groupings. So they're averages across groups of countries. That doesn't mean that if we say between 1% and 3% increase in revenues for this particular country group, that every country that fits in that group is necessarily going to be in that band. So at the more granular level, there will be a diversity of results that can't be seen when they're presented at the level that we're presenting them. As I said, at some future point, we hope to be able to present some country-specific material. Now, that's the first element there. In terms of the investment hubs, I think the story around investment hubs, as I think Ossa pointed out, is that to some extent what we see as part of the reallocation of tax base under Amount A of Pillar 1, we see that some tax base is being moved from low tax jurisdictions to higher tax jurisdictions. And investment hubs, one of the characteristics typically of an investment hub, even though that's not specific to the definition, is that quite often they either have low statutory and or effective tax rates. So that's one of the observations there. I had assumed that question was specific to Pillar 1, which is the case, I think. If that was not the intention of the person asking the question, we can address it more broadly. I should just really emphasise one point. On Pillar 1, what we have modelled is Amount A of Pillar 1. There is Amount B, and in the architecture of Pillar 1 there is Amount C as well. But we have focused the analysis on Amount A of Pillar 1. Just checking to see if we've received any further questions. It appears as though we haven't. On that basis, can I take the opportunity to thank you all? I'm told that there were somewhere in the order of 1,800 people register for this event. I'm assuming that when you subtract the fact that my mother probably registered a few times, there's still a great degree of interest out there in the work that we've been doing. And we thank you for that. As I said at the beginning of the webcast, these are preliminary results and insights. There are many assumptions that we make. The work, the negotiations is ongoing. There will be many decisions that will be taken that we have not been able to anticipate in the modelling that has been done so far, and they will have an impact on these estimates as we move forward. We don't present these estimates as if they're to be fixed in time. The real objective is to facilitate some informed discussion around the proposals that are on the table. The countries have had access to this information for some time. Now we are bringing some of that information into the public domain, and we do hope that that supports a more informed debate around some of these questions. We look forward to working with our country delegates and with external stakeholders, many of which I've already referred to, as we continue this work, and we look forward to, at a future point, being able to present to you a final analysis as and when that point arrives. Thanks very much for your participation.